All right, we will get started. Hello, everyone, and thank you all for joining us for our webinar today, where we will highlight the significance and benefits of charitable giving. My name is Chelsea Chartrand, and with me is Derek Duca. We are certified financial planners at the Duca Wealth Planning Group of Asante Financial Management. Now, before we get started today, there are a few items to keep in mind. Please keep yourselves muted during the webinar with your cameras off. We will be recording this presentation for replay at a later time. And at the end of the webinar, you'll have the opportunity to ask questions through the chat box. If you think of any questions during the presentation, please type them into the chat on Zoom and we'll answer them at the end. So today we're going to start by defining a philanthropist. You may discover that you are indeed a philanthropist, which may be one of the reasons why you're here today to learn more about the charitable giving and how it can help both the charity and yourselves. Once you've decided that you'd like to give and who you would like to give to, it's important to determine if you can afford to give, and if so, how much. We will also cover many ways to give other than just giving from cash from your pocket or your bank account. And lastly, we'll finish off with a Q&A session at the end.
All right. So what is a philanthropist? And would you consider yourself one? What pops into mind when you think of the word philanthropist? Well, the first thing that might happen is you might think of some big press release where some rich billionaire like Bill Gates or Warren Buffett or Mackenzie Bezos is giving some large amount of money to some organization. But is that really what a philanthropist is? Let's dig a little deeper and see what it means. So, have you ever volunteered your time, your talents, your resources, your money into any organization that benefits others? Well, congratulations. If you have, then you are a philanthropist. The dictionary definition is as follows. Philanthropist, a noun, a person who seeks to promote the welfare of others. And then it goes on, that's the key part that we like to think of. We have lots of clients that are seeking to promote the welfare of others. And then it goes on to say, especially by the generous donation of money to good causes. Well, so to us, the key is the heart that you have behind it. But there are some significant benefits. So we'll spend the majority of this presentation talking about the financial benefits related to giving money or other investments. So the first thing we have to do from our side of it is, for helping clients, is we have to make sure that you've got enough to meet your needs. And I'm going to turn that over to Chelsea to talk a little bit about how we do that.
Thank you. So let's talk about the pyramid of financial clarity. This might look a little familiar to something else. It's basically the financial version of Abraham Maslow's psychological hierarchy of needs. So we do financial projections for our clients, and the whole purpose of doing them for our clients is to ensure their expected needs can be met for their lifetime. So that includes running various scenarios like selling your home and using the net proceeds to fund the higher monthly expense related to maybe a retirement home living. We actually just hosted our last webinar on the cost of aging, and we all know how expensive retirement homes are. Or perhaps you want to help a family with an early inheritance, so you want to gift money to family while you're living instead of waiting until you've passed. So that's the gold category, your needs, making sure that your needs are covered. And then anything above your own needs is called excess capital. So maybe you don't object to the way our tax dollars are spent, but some of our clients do. And if that's the case, we look for tax efficient ways to not only meet your own needs, but to also have more excess capital to share with the upper tiers of the pyramid, like helping family, friends, or charities, or all of the above. So we realize that our tax dollars provide us with benefits, and here's a graphic that shows how the federal government spends our tax dollars. So this is, $1 of our tax dollars and where it goes. So as you may know, federal income tax was introduced as a temporary tax in 1917, and it was to help offset the costs of the First World War. Later on in 1918, the year following, only 2.6% of the federal government's revenue was derived from personal income tax. Temporary and tax both start with the letter T, but that seems to be the only commonality between the two. In today's world, personal income tax now makes up about 50% of the federal government's revenue. However, if you consider your tax dollars as an act of philanthropy, because you're contributing for the benefits of others, would you donate your money to these causes in the same proportions as shown here? So some of these we're aware of and can be on board with donating to, such as elderly benefits, which would contribute towards our future old age security pension, for example. Employment insurance, if we have to be off work due to injury, illness, or maternity leave, we can receive employment insurance from the government. Then there's children's benefits like the Canada Child Benefit for parents with young children and some lower incomes. Canada Health and Social Transfers for our healthcare system and such. But what about the others, like other transfer payments, which is 21 cents on the dollar? Where's that money going? So if you'd like more or a little bit more control on who your donations go to, there are a number of options that we'll discuss, and each of them have their own unique benefits. So the first one for the will, when you pass away, CRA assumes you've cashed in all of your investments the day before you passed. So if you have significant RSPs or RIFs or a cottage or other rental property, or even stocks with large capital gains, your final tax bill could be quite hefty. And naming a charity in your will is a great way to offset that income tax bill while supporting causes that are dear to your heart. Secondly, you can gift investments directly to a charity, either while you're living or through your will. Cash, it's pretty straightforward. You give the money and you get a tax receipt. You immediately save about 40% of the donation in the lower income tax, and you're still around to see the benefit to the organizations you supported. And then lastly, life insurance. Life insurance can serve a similar function, either by naming a charity or charities as beneficiaries, or having the life insurance proceeds flow into the estate to be gifted through your will. Now, Derek will explain these for us in a little bit more detail.
So, planned giving, you might have heard that term, and really it's about leaving a legacy. If leaving a legacy is important to you, then this is one way of doing it. And I'll just mention, we've helped clients with each of these 4 ways over our time in business and are continuing to do that. So planned giving simply means that you're planning ahead. And so what it is you name charitable organizations within your will that the money would go to. And it's very simple. You name, your children or whatever, how many heirs you have, and you can name a charity or multiple charities, either with a specific dollar amount or with a percentage amount. And depending on the amount of money that you want to donate to a specific charity and what the expected size of your estate is, one way might be better than the other. For example, if you have a specific amount, say you want to give $20,000 to a specific charity, you can name that. Now that's a specific bequest. And so what happens is that goes out to the specific people or organizations that you've listed in your will before any of the residue goes out to any of your other heirs. So you have to be careful about this. I had one client, she's passed away quite a number of years ago, but she was always single, never had family, but she had a very big heart and had named a number of charities with specific amounts and then some for, the residue to going to different family and friends. And we'll call her Sally. I said, Sally, upon looking at your will, I said, you have to promise not to die for at least another 5 or 10 years. She said, why is that, dear? I said, well, right now we don't have enough money in your estate to meet all your specific bequests, and there will be nothing left for your, your nieces and nephews and those kind of things. So in that case, we changed it to a percentage of her will. We also had a client, again, a couple didn't have any children, but quite generous. And they did have other family members as well, but they named a specific amount, a percentage of their will when the last of them passed to go to a number of different charities. And it was a fairly significant amount, but they had a fairly significant estate and quite a large tax bill. So when this all came to pass, the charitable donation was large enough to eliminate all the federal income tax. Now, there was still some provincial tax because provincial tax credits aren't quite the same as federal tax. And there was an excess left over, which in fact allowed the estate to carry the charitable donations back to a prior year and get a refund for the estate from one of the previous years. So that was a great way of doing it. So using the will as a charitable bequest means that you've got the use of your money all during your lifetime. It's only whatever's left that it goes out at the end after you've passed. It helps cover any estate taxes. And again, if your situation changes, the charity is no longer in existence, or you've changed your mind, you can always update your will and make that change. So let's move on to the next one. Now here, there's going to be numbers popping up as we go through this, but people give cash. They just write a check out or send what do you call it? E-transfer. But we found a better way for individuals that have open accounts, what we call taxable accounts, where they own mutual funds or stocks that have appreciated in value. So we're going to use an example of having $100,000. Now, it could be $10,000. Just the zeros is all that makes a difference. But let's say that the original cost of those securities were $20,000. You've had them for many, many years. And having been in business now for well over 30 years, I have some of my original clients that have some mutual funds they had for a long time, and they do have significant capital gains like this. So if the current market value were to be $100,000, we want to sell, you said, sell $100,000 because I want to give it to a charity. I would sell the $100,000, send you the $100,000, but you would have to report the $80,000 capital gain, of which half of it is taxable. So $40,000 is taxable. Top tax bracket, you'd owe about $20,000. And they did recently change the taxation of capital gains this year, that instead of 50% is taxable, 67% is taxable. However, that's only after you've received $250,000 worth of capital gains. So we're assuming in this example that this is all the capital gains that you have. So you would be at the lower threshold limit of including only 50%. But that still means that you would have to pay $20,000, which would only leave you $80,000 to give to the charity. When you gift securities, so rather than me cashing in the securities, sending you the check, and then you writing a check to the charity, if you simply said, here are the charity or charities that we want this money to go to, and we literally picked up the shares of your mutual funds or stocks, moved them to each of the individual charities, you still report the capital gain, but then there's a special exemption because you've gifted it to a charitable organization where you don't pay any tax on it. So you'd pay no tax on it, leaving you with a full $100,000 going to the charity. So giving cash, you would still end up with a very nice tax refund of about $40,000 at the top tax bracket. But the other way, you would get a tax credit of $50,000. So these are for the top tax brackets. Even at the lowest tax bracket, you would end up with about 40% or $40,000 if you donated the securities directly across. So you can see, and we've done this with people with $2,000, $3,000, $5,000. It's just a tax-wise way. If you've got money in an investment account that earns dividends, interest, capital gains that you're going to have to pay tax on, and you normally donate money to a charity, save yourself the trouble of writing out the check, work with us, and we can have this money donated from your open account, or if you're married, a joint account if you have a joint account, but any kind of taxable account where you've got capital gains, we can just move the securities over 1,000, 2,000, 5,000, whatever your need is, and you'll not pay the tax on the capital gains. Your charity will still get the money, and you'll end up with a little bit more tax savings out of it. So Chelsea, carry on with the next one.
Wonderful. Thanks, Derek. So now we're going to look at charitable giving through life insurance. So you can see here there's 3 different ways. So number 1 is the kind of easiest and most common. You can name a charitable organization as a direct beneficiary of your life insurance policy. So upon your passing, the insurance company would pay the death benefit directly to the charity, tax-free, doesn't go through your estate at all. And without going through the estate. So for an example, if you have a $100,000 death benefit on a life insurance policy, it would go to the charity and you would receive a $100,000 tax receipt. This option also allows you to retain control over the policy throughout your lifetime. So that means you can change the beneficiary to a different charity if you wish. So for example, if a charity ceases to exist while you're living, you could easily change it by updating the beneficiary. Or even if you just have a change of heart and you would rather your money go elsewhere, you can easily change it at that time as well. Number 2, you can designate the charity as a beneficiary for estate tax purposes. So in that case, the beneficiary of the life insurance policy would be the estate instead of the charity. And your estate would then receive the death benefit and distribute the money as per your will. In exchange for a tax receipt still, so you still receive the tax receipt, and it helps reduce your estate taxes. Now, the one downside to keep in mind in this scenario is the amount of the death benefit, because it goes through your state, is subject to probate. So in this case, the example of a $100,000 death benefit, you would still receive the $100,000 tax receipt, but your estate would have to pay $1,500 probate. And then lastly, the third one, transferring ownership of the policy to the charity. So if you have an existing policy, you can actually make the charity the policy owner and the beneficiary. In this case, you do lose control of the policy as you are changing ownership directly over to the charity. And in this case, you would receive a charitable tax receipt for the cash value of the policy. And if you continue to pay premiums in future years, you would also receive a charitable tax receipt for those premiums. For example, if you transfer the ownership of a life insurance policy that has a death benefit of $100,000, a cash value of $100,000, and annual premiums of $5,000, you will receive the charitable tax receipt initially upon ownership transfer for the $100,000. And then you continue to pay $5,000 a year, you would receive a charitable tax receipt for each of those premium payments for each of those future years. Now these can be quite complex with different tax consequences. So as always, it's best to speak to a qualified tax professional, like an accountant, to confirm the tax benefits for your own personal situation. So that covers off a few of the different ways of how you can donate. Now we're going to move on to something called donor advised funds. You've likely heard of private foundations, like we mentioned earlier, billionaires like Bill and Melinda Gates, Warren Buffett, they all have their own private foundation. However, there are many average people that are generous and want to make a difference as well. So let's take a look at how we can help with that. A donor advised fund, or a DAF for short, gives you all the benefits of a private foundation, but without all the complexity and costs of running one. And that's why they are the fastest growing giving tool in North America. So let's see how they work and how easy it is to get started.
Great. Well, it first starts with you, and with you having a desire to set up a strategic way of giving, both while you're alive and then possibly for some years or for a long time after your passing. What you need to do then is you need to come see us, see your Asante advisor. And then step 3 is we open up a donor advised fund, or a DAF account, for you, just like another account, like a tax-free savings account. This is a separate entity that is an account of its own. You would decide how much to donate to it in cash or securities. So if you have an open account, we could transfer some of your mutual funds over into the DAF, or you could just write a check. Secondly, for whatever amount you put into the initial contribution into the opening the account, you get a tax deduction for it. And then we continue to provide ongoing wealth management advice, investment instructions, and so on, as we do with your other accounts. And then Chelsea will take us into how the inner workings of the DAF go.
So as Derek mentioned, we continue to provide wealth management advice, because once you deposit that initial lump sum into the DAF, it's typically not all distributed at once. So it does stay invested inside of the DAF. And the investments inside of the DAF do grow on a tax-free basis. Just like a tax-free savings account, it's completely tax sheltered. And from the investments, you gift money from the DAF to registered charities each year. And like a RIF, you're likely familiar with a RIF, but your RSP gets converted to a RIF in the year that you turn 71, and there is a minimum that you must withdraw each year from 72 onwards. So just like a RIF, the DAF also has a minimum that you must give each year, but you can always give more than the minimum. There is no cap. It is important to remember, however, that you got your tax receipt when you donated your cash or securities to the DAF initially. So in future years, when you continue on donating each year, you do not get a DAF, or so you don't get a receipt when the DAF distributes money to your favorite charities in the future. So let's walk through a practical example.
All right. So just to confirm what Chelsea's talking about is anytime you donate money or securities into the DAF, you get a tax receipt for that. But once it's in there, it's now part of the foundation, which is a separate legal entity. And when that foundation, that DAF, donor advised fund, gives out to the various different charities that you've designated, there's no more receipt involved for you because you've already got it when you put your money into there. So we're going to walk through the structure of this, and then I'll actually show how we incorporate it into our family. So first off, you need to have a strategic giving philosophy of wanting to do something very specific and strategically while you're alive and even on beyond. Typically, it means involving other members of the family because you're wanting to engage multiple generations, or you may not even have children, but you want to have this carry on to leave a legacy on your behalf. You get an immediate tax receipt when you put money in. And if you're donating securities, you get elimination of capital gains tax upon the appreciated securities. You can name your donor advised fund anything you want. And it's low cost, low hassle, no involvement with CRA, thank goodness, compared to other options. If you're setting up your own private foundation, you need to get qualified as a charitable organization. Having been involved in a couple of organizations that have gone that route where they're seeking charitable status, it can take anywhere from 12 to 24 months and cost, if not thousands, tens of thousands of dollars to get that all in place. So this is very easy. You don't need to go through all that. It's already been done. And people say, oh, well, how much do I need to do? So if you're looking at private foundations, to make it worthwhile from just a cost benefit analysis, you'd likely need at least $1 million to make all those setup costs worthwhile. Using a donor advised fund, because we're literally part of a much larger fund that's already set up called the Benefaction Foundation, and they set us up as sub accounts underneath that, you can start with a minimum of $25,000. And then you can choose to give grants out of that donor advised fund totally anonymously, or you can choose to be recognized for it. Now, one reason that people who are generous sometimes like to be anonymous is because once their name gets out, they start getting phone calls, emails, and letters from just about every charitable organization, it seems, in the world saying, oh, you donated, would you like to support us, support this? So going through this would be one way of avoiding that, because you can just remain anonymous. So we actually took this to heart And Wanda and I talked about it, and we set up our own donor advised fund a number of years ago. We wanted to involve our family, and we sort of had a little chat with them, and it went something like this. It's not verbatim, but here's some little notes I made and from memory. I know we talked to them. We said, Mom and I wanted to just add a little bit to why we want to do this. I mean, we could simply give a little bit more money to each of you right now, and you might like that, and it would be beneficial in the short term because maybe you could use that money right now. But in the long term, it actually might be harmful. What we want to instill in you is that we've really been blessed by both sets of parents. Wanda's parents, my parents have helped us out, not just financially from time to time, but with their time and their effort and many different ways of helping. And we want to instill upon them an abundance mindset, not a lack mindset, so that there's more than enough. And we believe that God is our source, and he blesses us so that we can be a blessing to others. Not everything is for us. We need to share what we've got. So we involved multiple generations. We have 4 grandchildren at the present time. So what we did, so we put some money in. We got an immediate tax receipt. We were very original. We named our donor advised fund the Dutka Marshall Family Foundation, in honor of my parents, Richard and Rose Dutka, and Wanda's parents, Doug and Arlene Marshall, for all the help they've given. No cost, no hassle, no thousands of dollars of legal fees, no wrangling with CRA. Andrea and Chelsea had the paperwork ready literally in minutes, and we donated a little bit more than the minimum. So we now have each grandchild choose a charity each year. And we also said to them, at least initially, we're going to do this anonymously. It's not about us. It's about who we're benefiting. And so each of the grandchildren needed to spend some time thinking about what organization they wanted to sponsor, have this money go to, and why it was important to them. So just as an example for last year, we typically do it around Thanksgiving because that's a great sort of reminder of we've got lots to be thankful for. So some money, one grandchild chose backdoor mission for the relief of poverty. So that's great. Local mission here. One of them was comfort bears, which I'm thinking, what? They got teddy bears? Teddy bears is one of the things they do, but it's to provide teddy bears for young children suffering from cancer and serious diseases that are in hospital, may not get something else. One was to Dogtail's Charitable Foundation, which rescues dogs, as the name might imply. But for rescue dogs and rehabilitating them, putting them in good homes and so on. And then one went to...
To do that, you need to first be added as a member in the home settings of your home app.
Sorry about that. Who says Big Brother isn't listening? World Vision Canada for Gaza humanitarian emergency, because we're making this decision right around the time that Hamas attacked Israel and took all those captives. So this year there will be naming another charity. We've asked them, at least for these first few years, to name a different charity each year, just so that they can see all the different areas of need in our society. So that's how we've applied it in our situation. And Chelsea's going to talk about some specific areas that we've also used or are working on with clients for specific needs where this might be very beneficial.
Yeah, so of course it can be used for an great family experience, as Derek just mentioned, but it is also an excellent tool for unique tax situations, like the sale of a cottage or a business where you'll have an especially high tax bill for 1 year, but you don't want to give such a large amount in any single year to one or more charities. And this also works especially well if you normally donate to your favorite causes each year. So you simply set up the DAF in the year of the sale and contribute enough to offset most or all of the extra income tax you would owe, and then have the DAF make regular donations to your favorite causes in future years until the DAF is exhausted. Some other situations where a DAF would be useful is if you have to trigger large capital gains in a taxable investment account, or if you need to withdraw large amounts from an RSP or RIF. It's a great tool to offset a high tax year. Derek, can you finish off just letting us know how easy it is to get one going?
Yeah, there's one example we're working on right now, and I'll just use some simple numbers. These aren't the actual numbers, but so you'll get the idea. We have one client that has a significant tax liability, but normally gives about $5,000 a year because they triggered some capital gains earlier in the year and may actually be triggering some more before the end of the year. So for this illustration, let's say that they're going to owe $12,000 worth of income tax. We're working with them right now, and we've got to wait to see sort of what the next couple of months look like. But we're considering recommending setting up 25,000, just the minimum donor advised fund, because if they open that up, they basically wipe out that $12,000 tax liability that they have. They usually give $5,000 a year to various different charities. So in essence, what we're doing is we would then set them up to automatically pay out on the 15th of January each year the usual amount to that charity. So we're guaranteed at least next 5 years, depends how much growth is in the donor advised fund, how well the investments do. There might be enough there for longer. So we're really just prepaying the next 5 years. The client can still say, I'm supporting those charities, but I'm getting the tax deduction now. And so there is one situation where literally about a week is all we need to set up the DAF. And if the securities are with accounts with us, we can transfer the securities in, or it's even simpler. If you've sold a cottage and you have cash, you literally write a check. We can get the account opened up within 2 or 3 days and you'll get your tax deduction. So, you know, we also have another client that has a cottage listed for sale. They're hoping to sell it before the end of the year. So if they do sell it before the end of the year, then this is a strategy we've talked to them about because they've had it for a long time and there's a huge capital gain on it. So again, there's certain situations like this. Sometimes you're forced to, if you own a business, or again, have a large capital gain that you're forced to trigger. Last year, we had a client that was very disappointed in the sense that they'd owned an investment for a long time and it got bought out. He didn't want to sell it, but it went private and an organization came in and bought them all out. So he had to declare a large capital gain. He didn't really understand what it was about until it was too late for us to do anything about it. But this would have been something that we could have used in that situation as well. So I think you've got some questions. Did I miss anything? Anything else, Chelsea?
No, I think that covered everything. That's wonderful. So yeah, with that, we do reach the Q&A session. So we did receive some questions when the registrants have initially registered for this webinar. But if you have any other questions that have come up, please do put them into the chat box now, and we will get to them. So we'll go through just some of the ones that were originally put in first while we wait. Actually, before I get those, I just want to mention on this slide, we are present on all social media pages. So you can see on the right-hand side, we are on Instagram, Facebook, LinkedIn, and YouTube. So you can find us on all of those. And our next webinar will be the beginning of November on tax planning. So the first question here is an inheritance considered income?
Okay, so if you remember back to earlier when we were talking about what happens when you die, the CRA, Canada Revenue Agency, considers you to have sold everything, cashed in your RIFs, sold your cottage, everything, whether you did or not, from a tax standpoint. They consider you to have sold that, and everything gets taxable to the person that's passing away. So the estate will have to pay the tax on it. Then once the tax is paid, the inheritance goes out to the beneficiaries. So you're the beneficiary or heir is the inheritor. They're getting that money in. There is no tax to you because it's tax paid. Now, once you get the money, let's say you got $100,000 and you now invest it in something, whatever you earn on that $100,000 becomes taxable income to you. But initially receiving the 100,000 or 500,000 or 10,000, whatever the amount is, it's not taxable to you because the estate has already paid tax on it. But what you invested in then can lead to taxable income for you.
Another question, what is the minimum which must be donated from the DAF each year?
There is a regulated amount by the government. It just went up in the last budget. I think it's about 8% a year. I would have to double check that. It's not a huge amount. Again, part of it is because the whole idea of a foundation is something that's there to provide ongoing things, ongoing gifts for many, many years. So it's definitely less than 10%. I believe it was right around 4%, and then it went up. They almost doubled it because they didn't want, some of these foundations were earning way more money and not divesting much of it. And so the government said, this is a little bit too much here. We're giving people tax breaks to put money in, but they're not distributing anything. This is just kind of, they're building up a store of wealth there, and we would like to get our hands on it. Much like the RIF income, there's a minimum there that continues to increase year by year. The donor advised funds, it doesn't increase year by year, but they did increase it from the initial level to, I believe it's around 8%, 6 to 8%. So again, if your money is well diversified and invested, it would last a long time if you just did the minimum. You can do more than that, but as long as you do the minimum each year, that's fine. And you can do, may have sort of alluded to it, we've chosen to actively select who the money is going to each year. But if this is more of a legacy thing, or if you're just trying to do a tax strategy, as we're talking about with this one client, they can set it and forget it. They can say, here's the 3 charities that I want to go through. Here's a percentage or dollar amount that I want to go out to them, and do it on the 15th of January every year or whatever. And until you decide to change your mind, you never have to look at it again. It just rolls around and does it automatically. So again, it can be very, very simple and easy to run. Another question?
Yep. In cases of vacant land, can it be gifted? And if so, which party pays the land transfer tax and legal fees? And would capital gains be payable and subsequently offset by the donation?
Okay, this one's a little more complicated. We haven't covered all the ways of gifting. There are gifts of cultural gifts, there are gifts of land, there's gifts of art, all those kind of things. So yes, you can gift vacant land to a charity. You would have to talk to the charity about how they're set up and how they would receive it. It would likely be very advisable to get a professional appraisal for the value of the property, because what would happen, to the best of my understanding, and this would need to be verified with the charity and with a specialized tax accountant that is totally aware of these things and all the ins and outs, is that from my understanding, let's say that your property was appraised at $150,000 fair market value. You talk to the organization, they're a charitable organization, and say, yes, we'd love to take this land, either because they're going to develop, put a camp on it or something like that, or they're saying, you know what, we've got absolutely no use for this, but we'll give you the receipt and we'll turn around and sell it and we'll use this money for something else. So you would go through the legal process of gifting that to them, changing the title. Now, who pays the land transfer tax? Who pays the legal fees and so on? Again, that depends on your situation. Some people have enough money and resources to say, hey, we want the charity to get the maximum benefit out of this. We'll pay for all those, and the charity still gets the property. In other cases, people might say to the charity, so like, if you want this, we're willing to give it to you, but we don't have the extra money to cover the appraisal fee, the land transfer tax, and all that. I'm sure the charity would be more than willing to pay a few $1,000s in legal fees and land transfer tax to get in the much greater benefit. So again, $150,000 in this example, you're gifting them, you'll get a receipt for $150,000. Let's say that you purchased it for $50,000, you've got a $100,000 capital gain, but because you've gifted it, you will owe no tax on that. You report the tax and say, I gifted this, so I don't owe any tax at all. You'll just get a receipt for the $150,000 and have a great tax refund from every other source that you have. So the capital gain would not be included in your taxable income. Hopefully I've been clear on that.
Yes, good. And last question, unless more come through, how to best make a difference or impact through non-tradition charities, like charities that might not be eligible for a tax refund. For example, giving to people in need directly, donations at the grocery stores to round up or add $1, or providing rent relief for tenants.
Excellent question. And those are great ways of helping others, very philanthropic. Unfortunately, from a tax side of things, there's no benefit there. But let's forget for a moment about the tax benefits. Are you impacting a life? And nothing is too small to impact a life. And we too often shrug it off, say, oh, well, it's only $5, or it's only, a couple of boxes of Cheerios or whatever. But to that individual that's receiving the benefits, that could be a life-changing moment for them, however small it may seem to you. So every time we take an action that lifts someone else up out of a poor situation, that in itself is a great reward. We may never ever know how much that helped a person. Again, especially if we're giving it a food bank or rounding up at the till, those kind of things, we never see the end result of where it goes. But there could be somebody that literally was kept from going homeless because of that donation. And they turned around and became, the inventor of, I don't know, some fuelless automobile that we don't need to use oil and gas or batteries or whatever, or create some cure for some great disease. So never overlook the impact of doing something to make this a better world, to help another person out. Hopefully that answers that.
Yes. Wonderful. So that's all the questions for this webinar. If you do have any others, please feel free to reach out, give us a call or an email, and we'd love to answer any kind of questions with regards to charitable giving and more. Lastly, we wanted to thank you for viewing and attending this webinar. As mentioned previously, we are hosting another webinar in November on year-end tax planning and tips. So until then, we hope you enjoy the end of the summer. And any closing notes there, Derek?
Yeah, we will be posting this on our site as soon as we send it up to compliance for approval. So if there's anything that you think you missed, go back and listen to it again. If you've got friends or colleagues that might find this interesting, you can just send them to the link and they can take a look at it, or send them to us and we'll explain it personally. Anyhow, thanks so much for joining, and we'll see you soon.
Take care.